Hello and welcome to Buy Africa, the show where we focus on investment opportunities around the continent. I'm Tepo Mudiba, and thanks for joining me. Tonight, I'm joined by Roy Daniels, Head of Africa Trading at Rand Merchant Bank, for a closer look at the decision by Nigeria's MPC to introduce a flexible interbank forex market while retaining a small official window for critical transactions. That's a mouthful. Nigeria, what's going on?
It's a tough one to understand. I mean, we're sitting there in the office and we're debating what is a flexible FX market. We're not quite clear what that is.
I'm glad you guys are having that discussion. I was just about to ask because I'm not really sure what that is.
Yeah, you know, for us, the biggest concern is that the market's under pressure in Nigeria. There's uncertainty, the market's nervous, there's a struggle to pay for imports. There's a massive queue of dollars waiting dollars to exit the country for previous sales of bonds or whatever fixed income or whatever transactions have taken place. So you've got the queue, the market's nervous, there's confusion, and then you release a statement that says this is what we're going to do without telling us what it actually means and where does it go from here and what does a flexible exchange rate market mean. It's not a floating.
Right.
Does it mean that there's going to be certain imports, say critical imports, allowed at a certain level, and other imports at the next level, and then something else at the next level?
And who determines that?
Who determines what they are?
Right.
They'll announce which ones are which, but who monitors it? Where's the admin? Now you're creating additional admin for the actual markets and for themselves at the CBN.
Right.
For us, it would have been easier for them to have come out and said, we agree that the currency is overvalued. We've held on for as long as we can. We feel the official peg should move to 225 or to 240, whatever the case might be. Now the markets are speculating that, does this mean they're going to float the currency? So the clear indicator for us is the non-deliverable forward market or NDF market.
Right.
What the move yesterday was quite sharp and quite harsh,
Right.
and quite costly, unfortunately. So the move is quick on the negative side, and I think the 6 months move from 270 to 310 traded back a little bit. The parallel market, or unofficial market, where surprisingly the central bank has told the fuel importers they can go access that market to pay for the fuel imports. Now, it's surprising that a central bank would say to a large industry like the fuel industry to go and use a parallel market. I mean, surely they don't want anybody to use the parallel market.
Yeah.
The parallel market shot up quite sharply again to 340. It traded down slightly today to 310 as we're all sitting there, all the banks and all the internationals trying to digest, as we say, flexible foreign exchange market, term we haven't heard before.
Right.
Back up now recently, just before we started the interview, back to the 340, 350 level. So uncertainty. All they've done is they've taken a nervous market, thrown in a drop or two of uncertainty. Everybody's running for their heels. Nobody knows what to do.
At the forefront of this, is this simply highlighting the fact that to peg your currency, you actually have to have money to do that?
You always have to, you have to have money for any, whether you've got floating currency or peg currency. Certainly if you believed you want to be pegged, you've got to be able to support the market at that rate.
Right.
The downside of that is that sure, it's pegged and there's no volatility in your market and things look fine. But the problem being then for your exporters, when all of emerging market is weakening and all other emerging market currencies are weakening, export-driven markets, exporting whatever you like from your market, you're going to generate more local currency for it.
Right.
If you don't allow that to move, you're still earning the same 200. So importers are benefiting.
Yep.
Exporters, which are the balance of your current account is from your exports, they're not benefiting from it. So they don't want to export because the costs are going higher. Because you're buying some imports at the parallel market, you're building in unofficial inflation into your economy, which you're not reflecting because you're sticking at the 200 mark.
Sure.
So now you're stuck with this, do the exporters export or not?
Sure.
As an investor wanting to go into Nigeria, if you were sitting there and you had funds to go into the equity markets or the fixed income market, you wouldn't have done it now because you're waiting for this devaluation or revaluation of the naira.
Right.
So you're looking for it to go to 240 or to 280 or to 300, wherever the market's determined. You're waiting for that to happen before you go with your currency.
And that exacerbates the current situation in that there's no flow into Nigeria right now.
Really no flow coming in. There's no FDI coming in. There's no one investing into the bond markets. Yields are looking more attractive, but now we're saying because of the unofficial inflation that's imported via the parallel market, that still has to reflect into the inflation number. So yield should tick up still, and the rate should weaken.
Right.
So on both fronts, we're waiting for things to happen before we'd say, right, these are now the nice levels to go and buy into the fixed income market. On the other side of it, the NDF market, non-deliverable forward market, is showing you fantastic yields.
Right.
So you're finding guys switching out of the longer term products into the shorter end NDF market and picking up yields. The 1 month, when there was talk, there was a release of a document out of the States by somebody saying that it's imminent that the CBN is going to devalue the currency to 300. The 1 month non-deliverable forward market yield jumped to over 200% when compared to what the rate is to the official spot rate. So that 1 month went from 210 to 266. And that gave you this fantastic yield. Of course, you're not really going to get into it because you're thinking, well, sell it there, where's the peg coming in?
Sure.
What this flexible market problem also exacerbates for us is when you do non-deliverable forwards, a non-deliverable forward means in the future you're not going to settle on the capital, you're going to settle the difference of the two prices.
Right.
So you can buy a non-deliverable forward rate at 240 and you say, when 3 months come, we settle against the official spot rate.
Okay.
Now they don't want to move the spot rate. They keep it pegged.
Right.
So which rate are we going to use for the setting on due date of non-deliverable forwards when we have this flexible foreign exchange rate, which hopefully they're going to give us some clarity through the course of the week. They have said, the CBN has said they will give us clarity by Friday as to what it means.
Right.
But it's a long time from Tuesday to Friday.
That's a very weird thing to say, in that why don't they give clarity immediately? Does that imply that they're not really sure what they mean by flexible?
That's a leading one. That's put me on a bit of a spot here. I think that they're clear in what they want to do. Maybe they don't have enough time to officially put it all out there.
Fair enough.
And give them that benefit of the doubt, but we would have expected something within 24 hours.
Right.
So it's disappointing that it hasn't happened. It's disappointing that they've allowed the speculation as to what it means to take place.
Right.
When your markets are nervous, when your markets are uncertain, when your markets are vulnerable, you have to remove uncertainty and speculative sort of discussions around the market is. It might well be the flexible market, as we said, means certain goods at one level, certain goods another, or do they say, look, we recognize that the parallel market exists and we're now going to have an official rate and a parallel rate. Now, the parallel rate means it's unofficial, means that the rate over which you have no control. I would think from the CBN's actions and from the President's comments over the past 6 months, they want as much control as they can have.
Sure.
So they need to look at that parallel market. They need to close that gap of those two markets. They need to almost, you don't want a parallel market ideally, but it's happening now for the last year. What do we do to get rid of a parallel market? How do we get to have a flexible rate that at one stage we can say we're now going to go floating? Ideally, as the largest economy in Africa, you need to have a floating foreign exchange rate.
Right.
You can't be the largest economy and have pegged rates and total control. The central bank needs to be autonomous. It needs to have a floating rate. You need to use your exchange rate as your current account balancer.
I guess the critical argument that government has been using for some time is that a lot of Nigerian businesses are importing. So by pegging the currency in their mind, they're facilitating or assisting most of Nigerian business.
You protect the importing business,
right?
But your growth, your internal growth within your country comes from your exports. Your exporters are the ones that grow it. We've seen it here in South Africa, that when the rand weakened, the exporters suddenly had a business and they could now start exporting more goods. And you want to have manufacturing in your own country. If you keep it pegged, it doesn't help you exporting because the price of what you're trying to export is cheaper from everywhere else.
Sure. So you're not as competitive.
You're not as competitive. How do you make your markets competitive? What do you do? I mean, the one thing they export crude, they import fuel. Number one export.
Yeah.
Number one import is fuel.
Yeah.
So I know they're building refineries and I know they're taking place, which is probably something that maybe should have happened sooner. But you need to look at it and say, yes, we want to make it tougher for guys to import, but we want to grow our market. So what they did is they said, right, these 42 items that we're busy importing, you can no longer source those dollars at the official rate.
Yeah.
So how are you then protecting the guy that's importing those goods? So if you're a clothing manufacturer or a clothing retailer, and you go open up a business in Nigeria now, you can't use the money that you make in country, the profits you make, to buy dollars to pay for the imports of the goods.
Sure.
So how does that then grow the business? If you're going to be a retailer, open business, you're going to employ people, you're going to create jobs for people in the country, but now you can't pay for your goods. So the importers, those guys are pulling out. The retailers in South Africa are having serious doubts about should we be in these markets. and how do we pay for our goods?
You've spoken about, I guess, at the business level, the investors. When you're looking at equity market and bond market right now as an investor, what's the take? Is it a wait and see? Is it invest in Nigeria and anticipate that it's going to be a very long-term investment? What's really the investment thesis right now?
I would say for now it has to be wait and see.
Right.
You know, you might have had a view earlier last week to say, look, I'll invest and I'll wait and see how it pans out. And I hope that the weakness in the currency will be offset against my gains elsewhere. We're all waiting for the currency to move. We're all waiting for the peg to move to actually say, now's the right time to invest.
Sure.
But when you have these levels of uncertainty and the comments that come out like this, it doesn't help you. It doesn't help us to speak to people that want to invest in the country to say, look, we think it's a good time to invest. Sure. When we ourselves are saying, from a short-term investment point of view, it's not the right time. From a long-term investment point of view, and from a bank point of view, from a group point of view, we've got our office there. We are committed to the growth in Nigeria. We're committed to the Nigerian markets, absolutely. But for a short-term investor, looking for the yield players, the yield pickup players, those are the guys we're saying this is not the right time to do it. The other markets that are looking more attractive, the other markets offering you equal returns, and an opportunity where you get in, you can actually get out.
Sure.
And that might be a Kenya, it might be a Zambia. I think Zambia offers good value right now. Ghana is looking like a slightly better market to invest in. Nigeria has become a sort of wait and see. Let's find out what flexible exchange rate means. Let's find out, are you as an investor into any equity market or financial market in Nigeria? Where's your protection? Where's the guarantees that, look, come and buy our local currency bonds. We will assist you when you want to get out, when you want to sell off, because it is about turning positions.
Sure, perfect. Let's leave it there. Thanks to my guest, Roy Daniels, Head of Africa Trading at Rand Merchant Bank. That's all from Buy Africa this week. Remember to follow me on Twitter. That's @Mudiba_Tsapo. And send us your thoughts about the show using the hashtag BuyAfrica. From myself and the team, goodbye.